let's be clear about what is actually being proposed and what is not. This is not a sweeping overhaul of the housing market. It is a targeted strike at a specific actor, large institutional investors, private equity firms, corporate landlords. The idea is simple on its surface. If big money stops buying homes, more homes should be available for families. But housing is not just a moral issue. It is a system. Prices are shaped by supply constraints, interest rates, zoning laws, construction costs, and demographics, all moving at once. Institutional investors have become an easy symbol. They are visible, they are powerful, and in some communities, they are deeply unpopular. Yet even within the data, their role remains contested. Are they dominant players or convenient villains? This is where politics enters the story. A policy can feel right, sound right, and still miss the real engine driving the crisis. To understand whether this proposal changes outcomes or simply narratives, we need to look at how America arrived here in the first place. And that story begins not today, but nearly 2 decades ago. After the 2008 financial crisis, America's housing market did not simply recover, it transformed. Millions of homes were foreclosed, entire neighborhoods were hollowed out, and into that vacuum stepped Wall Street. Private equity firms, armed with cheap capital and low interest rates, began buying single-family homes, not to live in, but to rent. This was not ideology, it was opportunity. Housing became an asset class. Homes were bundled, scaled, optimized. Algorithms replaced neighbors. Ownership shifted from individuals to balance sheets. In certain cities, this shift was rapid and concentrated, creating a sense that something fundamental had changed. At the same time, wages stagnated. Younger Americans entered adulthood burdened by debt. Zoning laws restricted new construction. And over time, a quiet imbalance formed between supply and demand. The result was not one single villain, but a layered system built slowly, reinforced by policy, and accelerated by capital. By the time interest rates rose and prices surged, the damage was already embedded. And then came the first rupture when the politics finally caught up with the economics. The first rupture came not from policy but from markets. When Donald Trump made his announcement, Wall Street listened, and it reacted fast. Shares of Blackstone fell more than 5% in a single day. Companies tied to single-family rentals dropped sharply. This was not panic. It was recalibration. Markets are ruthless truth-tellers. They don't respond to speeches. They respond to incentives. Trump's words signaled something important: political risk. For years, institutional investors assumed housing was safe terrain, too complex, too local, too sensitive for aggressive regulation. That assumption cracked. Suddenly, a practice once tolerated became controversial. A business model once framed as efficient was reframed as extractive. And housing, normally slow, stable, boring, became politically radioactive. This moment mattered not because of what was enacted, but because of what was challenged. A line was drawn between capital and citizenship. And when that happens, the real story is never about headlines. It's about the hidden machinery underneath, quiet, technical, and far more powerful than any single ban. That's where we need to look next. Behind this debate sits a mechanism few people ever see. Institutional investors did not raise housing prices by sheer volume alone. Their real influence came from concentration and predictability, buying in clusters, targeting similar homes, setting rents algorithmically. In certain markets, that created local pressure that felt overwhelming to residents, even if the national share remained small. And here is the paradox. On paper, institutions own a limited slice of America's single-family homes. Depending on how you define them, the number ranges from 0.5% to roughly 4%. Small, statistically, powerful, emotionally, because markets are not experienced as averages. They are lived street by street. Policy struggles with this distinction. National laws operate broadly, while housing pain is intensely local. A blunt ban may sound decisive, but it collides with messy realities, definitions, enforcement, and the question no one answers: what happens to homes already owned? This is why economists hesitate, not out of indifference, but because systems adapt. And when systems adapt, pressure rarely disappears. It simply moves. Which brings us to the second rupture, less visible, but more consequential. As interest rates climbed and affordability worsened, institutional buying slowed, yet prices remained high. That alone should give us pause. What analysts began to notice was substitution. If large investors step back, mid-size and smaller investors often step in. Capital does not vanish, it fragments. And fragmented capital can be harder to regulate, harder to track, and no more aligned with first-time buyers. This is the uncomfortable truth. Banning one group does not guarantee homes flow to families. They may simply flow to different investors, less visible, less regulated, but just as profit-driven. Housing supply remains constrained, construction costs stay elevated, zoning laws still restrict density. None of these pressures disappear with a single policy announcement. So the crisis deepens quietly beneath the surface of political theater. And that silence is felt most sharply not by markets, but by people, which is where this story stops being abstract and becomes personal. If you are watching this, there is a good chance housing has touched your life. Maybe you rent and wonder why it feels harder every year. Maybe you want to buy and keep getting priced out. Maybe you did everything right and it still wasn't enough. This debate is not theoretical for you. It is emotional. It shapes where you live, how you plan, whether you feel secure. When leaders say they are fighting for affordability, they're speaking to that anxiety. And when they name a villain, it can feel relieving. Finally, someone is listening. But relief is not the same as resolution. If housing matters to you, truly matters, then the question is not who we blame, but whether policies actually change outcomes. Share this conversation. Stay engaged. Because systems only shift when people understand how they work. And what's happening here is bigger than America alone. Housing has become a global fault line. From Europe to Asia, governments are confronting the same tension. Homes as shelter versus homes as financial assets. Capital moves across borders faster than people. And when returns shrink in one market, money searches for another. America's debate signals something larger. A rethinking of how far markets should be allowed to shape essential goods. When the world's largest economy questions financialized housing, others pay attention. But global systems are interconnected. Policies ripple. Restrictions in one country can redirect investment elsewhere. And uncertainty, once introduced, never stays contained. This is how domestic politics becomes geopolitics, not through speeches, but through incentives. Which leaves us facing the future. Not one future, but several. And none of them are simple. There are three plausible paths ahead. The optimistic path is structural reform. Increased housing supply, smarter zoning, tenant protections that raise standards without distorting markets. In this future, ownership slowly becomes more attainable, not because investors are banned, but because homes are built. The middle path is symbolic politics. Bans are debated, headlines are made, markets adjust around them, prices stabilize, but affordability remains strained. Discontent simmers. The darker path is fragmentation. Large investors retreat, smaller ones proliferate, regulation lags, and the core problem, too few homes for too many people, intensifies. History suggests systems choose the path of least resistance, which is why moments like this matter. Not for what is promised, but for what is confronted. And that brings us to the final insight. Housing tells us who an economy is really built for. When homes become primarily assets, citizens start to feel like bystanders. When politics responds with symbolism alone, trust erodes further. Donald Trump's proposal taps into something real, a sense that the American dream is slipping away. But restoring that dream requires more than identifying villains. It requires confronting systems. The question is not whether corporations should own homes. The question is whether societies are willing to align markets with human needs. If this conversation resonated with you, stay here. There is more to unpack, more systems to examine, more illusions to strip away. Because the future of housing is not just about where we live, it's about who we are willing to build for. And that conversation is only beginning.